Welcome back to Project Pulse. In the previous lesson, we modeled depreciation and amortization, which is what we need to move from pre-tax economics to after-tax economics. And in this lesson, we will use a depreciation output to calculate unlevered taxes. And then we'll compute the unlevered after-tax project IRR, which you can see here on the dashboard. Unlevered still means no debt. We're looking at the project return before any debt financing. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. Let's now go back to the operations sheet in our checkpoint file from the previous lesson. The goal for this lesson is to convert operating results into taxable income, apply tax logic, and produce the after-tax free cash flows for the IRR. Alright, in the previous lesson we have left off with our depreciation and amortization line. And that allows us to now calculate our EBIT, which are our earnings before interest and tax. And to do this, what we'll do is pull in our EBITDA from our previous lesson, which are our earnings before interest, tax, depreciation and amortization. And this is a positive number, so we pick up K399. And then we subtract depreciation and amortization, which is a negative number. So what we'll do is say plus 448, hit enter, drag this over, Control R. And we can see that our EBIT in the first 5 years is negative. So our earnings before interest and tax are negative, although our cash flow isn't negative. It's just our earnings because our depreciation and amortization over a 5-year makers period produces a negative earnings before interest and tax. And what you have to keep in mind here is that depreciation and amortization is a simple accounting metrics for tax purposes and not an actual cash outflow. You can visualize it that way, that for the battery packs, we actually had to pay upfront in 2025 before we even started operations. But for tax purposes, we deduct these expenses over a period of 6 years instead. Then once we have our EBIT, we can subtract our unlevered taxes to then arrive at the after-tax free cash flow. And our unlevered taxes, we actually calculate down here. So what we do for now is a simple linkage to row 479, although this is empty for now. Drag this over, Control R. And then let's move on to our after-tax free cash flow. And this one here, don't be tripped up here, is not going to be our EBIT minus our unlevered taxes, but instead we pick up our after-tax, or better pre-tax free cash flow from the previous lesson, which was the sum of our total capex and EBITDA, or operating cash flow, which we already calculated in row 401. And that was pre-tax, so we haven't modeled any taxes yet. So we can simply pick up this pre-tax free cash flow that we've already calculated and then add plus our unlevered taxes, because these will flow in negative. So that's K401 plus K452, hit enter, drag this one over, Control R. And we can already set up the unlevered after-tax project IRR formula. We can actually just copy this formula from the previous lesson, hit Control C and Control V. Let's see if the reference is right. And we take the after-tax free cash flow as well as the timeline up here. And no surprise, we get the same IRR. How come? That is because we haven't modeled our unlevered taxes yet. So this line is still 0. And this is what we're going to do next. But before we get to the actual unlevered taxes down here, we will set up also our property, plant and equipment account, as well as an account for non-cash amortization of deferred financing fees. And we will need all of these accounts to ensure that ultimately our balance sheet will balance. And for now we get a balance sheet error. And very likely we'll keep getting this balance sheet error up until almost the very last lesson. And that is because right now we are still missing the full financing structure. We haven't modeled our debt and equity. and all of these accounts are still missing. So what we'll do in the meantime is go to our checks sheet, and for our balance sheet check, we will actually turn this check off for now, so that when we're in our operations sheet, we don't keep getting a fail, because we know that our balance sheet cannot yet balance because we haven't modeled all our accounts and our financing structure yet. And now let's focus on our PP&E account. Property, plant and equipment, or also referred to as PP&E, is basically the accounting bucket that tracks the project's fixed assets over time. And we need it for two reasons. The first reason is that it drives the balance sheet asset value over time. And second, it also keeps the model internally consistent. Additions increase PP&E and depreciation reduces it. So it's very essential that we link in our balance carried forward into our balance sheet once we're done with this. And an account is always set up the same way. First, we always pull in the balance brought forward from the previous balance carried forward. So here we refer to the empty cell down here. Hit enter, and the balance carried forward is the sum of the cells above. So take the sum of the balance brought forward plus additions minus depreciation and write-offs. Hit enter. And both these values are of course 0 in the beginning. And then for our additions, that is going to be equal to, let's scroll up, our actual CapEx excluding financing fees in row 350. So those are total capital expenditures, all the equipment we have been paying for, excluding any financing fees, because these will be treated differently. So pick up row 350. But then let's not forget about our augmentation CapEx. So plus, let's scroll down. We also have our total augmentation CapEx in nominal terms in 371. So make sure you pick up both of these row totals. Hit enter. And then for the depreciation and write-offs in 462, this is going to be a simple linkage to our previous lesson output in row 448. So this equals row 448, which is already negative. Hit enter. Let's drag all of this over, Control R. And you can see that initially we built a balance of 114.5 million in PP&E, and that is reduced over time in accordance with our maker's depreciation schedule. And then in 2033, upon our first augmentation event, there's an 11.5 million increase, which gives the PPE account a light bump. And then it keeps decreasing further up until ops end. And in the end, there is still some depreciation left on the table due to our second augmentation as well as our interconnection expenses, which is why for that reason we still have some assets sitting in the PP&E account indefinitely because they haven't been depreciated. Let's move to our integrated financial statements, and you will see that our PP&E account now shows up here on the asset side. But what we are missing on the other side is how we finance these assets with either debt or equity, which is why we still get a balance sheet error. So let's move back. And that was our PP&E account. And next is the amortization of deferred financing fees, which is our next account right here. In real financings, lenders typically charge upfront fees or arrangement fees. And these are often paid at financial close. But for accounting and tax purposes, they are typically treated as a non-cash expense spread over the debt tenor. So for instance, if you have a debt tenor of, say, 15 years and an upfront fee of $1.5 million, then we would spread this out over a period of 15 years and each year $100,000 tax-deductible amortization instead of just charging the $1.5 million at financial close, which could reduce taxable income in the income statement in the year the financial close takes place. But instead, what we're going to do here is spread this out over 15 years. And the general account setup is the same as before. So we hop into K466, and that equals to the previous period balance carried forward. Hit enter. That's the sum of the cells above. Then our additions equals to something we haven't yet calculated, but we still can implement the linkage. And that is our financing fees in the CapEx section in row 354. So we just create a simple linkage here. These financing fees will be modeled positive, so we don't need to flip the sign here. Hit enter. Those are going to be our additions. So for instance, if this is 1.5 million, we would add this to the account right here in the first period. And then for the amortization, this is going to be equal to minus, since we want to make sure that it reduces our overall account balance. And that's the sum of our total additions in J467. Hit F4 once to fully anchor it. So that just takes all the additions we have throughout the full asset life, and we'll divide this by our actual amortization period, which is going to be equal to our actual financing tenor in G468. Let's also fully anchor this one with F4 once. And then lastly, we'll multiply this with, let's scroll down. Here in the term loan sizing section, we actually have our term loan tenor and a term loan flag, which hasn't been implemented yet. So we'll just multiply it with this flag, just so the account is set up, although we haven't yet modeled any of these sections. Hit enter. We just want to make sure that we're not forgetting any of this. And since all of these values are 0 for now, and we want to make sure that we are not getting an error for dividing by 0, we will wrap this by an if error statement. So if error, then this should equal 0. Hit enter. And that should allow us to drag this over. Control R. I know this is a little abstract, but we want to avoid accidentally forgetting setting this account up later on. So let's just do it now. All right, these were the two accounts that we need for depreciation and amortization accounting. And now the final account that we'll model is our tax loss carry forward account. And the tax logic is essentially that the project generates taxable losses in early years, as you can see in our EBIT line. Due to very high depreciation in early years, we have a negative taxable income in these years. And these losses are usually not wasted. They accumulate in a tax loss carry forward account, which we'll model down here. And what happens is later when the project becomes profitable in years 2031 onwards, we can use those carried losses to reduce taxable income, which then ultimately reduces taxes paid and pushes the tax liability out further into the future. So we essentially just reverse our losses that we materialized in early years into later years. And to do this, we can set up the account in the same logic as previously. This equals the previous balance carried forward. This is the sum of all of these guys. And for new losses, what we'll do is we'll take minus the minimum of our earnings before interest and tax and 0. Close parentheses. So whenever this number here is negative, we want to pick it up and we want to build up our tax loss carried forward account. And we need to flip the sign, because if we pick up a negative number, we don't want to build up a negative account. We want this account to show up positive, which is why we flip the sign. Hit enter. Let's drag all of these over for now. Control R. And you can see that in the first 5 years, we build up losses. And we basically generate 43.9 or 43.7 million in tax losses that we could later on reverse instead of already starting to pay taxes in 2031. So the actual tax bill will probably be pushed out by a few years by reversing these early tax losses. And this is where our utilization comes into play. So right here, we will include an if statement. If our EBIT in K450 is greater than 0, which means we have a taxable income, then we want a minus min of our EBIT right here, and comma our balance brought forward. So whatever is smaller, our EBIT in that year or our balance brought forward should be the actual utilization of the account, close parentheses. And if this is false, then we want a 0 and close parentheses. Drag this over, Control R. And you can see that we actually reverse our losses just as intended in the next 6 years after we initially built them up. So our first taxable event or taxable year will actually be 2036. That means that right here we can actually model in 478 the taxable income after loss reversal. And that is going to be equal to the maximum of 0 and our EBIT right here plus our utilization in row 475. So that means that this number here, because we choose the max of 0, can never turn negative. So if our EBIT is negative, it picks up 0. And if our EBIT becomes positive, we subtract this negative number here. That's why it's plus 475, which is modeled negative. Close parentheses, hit enter, drag it over, Control R. And you can see that our taxable income essentially only kicks in 2036 and onwards. And that means that we can now model our unlevered taxes, which is equal to minus our taxable income after tax loss reversal times our tax rate of 25%. Hit F4 1, 2, 3 times, hit enter, drag it over, Control R. And you can see that our unlevered after-tax project IRR just dropped from 6.02% to 5.01%. If I hit Control Z, you can see the effect again. Right now we have 92.5 million after-tax free cash flow. And once I hit Control R again, you can see this drops to 69 million and our unlevered after-tax project IRR is 5%. Perfect. We have now built the unlevered tax block and calculated the unlevered after-tax project IRR, which is the clean project economics after taxes and before financing view. And in the next lessons, we will start modeling senior debt. And we will see how financing reshapes cash flows and moves us from project returns to levered equity returns. Alright guys, this was it for this lesson, and I will see you in the next lesson. See you there.